Yeah, I wish I had taken my excitement in 2022 and bought more IBM. I'm kicking myself for not
Right.
having more shares when it was around the 120 range. And now, if you look at it, they perform, as you said, relatively better than the rest of the market during 2022. But looking forward, I think the what people are going to be looking for as investors is there's still steady growth, right? If you look at their CAGR, they're estimating about 3.4% for this year, and then out to 2024, about 6.6% compound annual growth. So those are the things that you want in times of uncertainty. One thing they also did over the last 5 to 10 years is divesting in assets that weren't as profitable for them, and that's made them a lot more efficient. And they're focusing on those growth areas. So that's what makes this exciting time for investors that are invested in IBM, Kelly.
Or it should be, but did Microsoft just cast a bit of, I was going to say a cloud, a shadow over things? Delano, what's your read on the Microsoft quarter and some of the headwinds it now poses as we move into through IBM and also next week more of its mega cap tech peers?
Yeah, we'll see. I think, the big thing that everyone was looking at was obviously the cloud growth. And I'm speaking for someone that does enterprise services. That's an area that everyone is really focused on, is that cloud growth. And I think it's the biggest factor. And so I think their earnings were okay. We're seeing them down a little bit now, but, pulling back. But it is a bellwether for the rest of tech, right? And seeing if the demand is sticking or softening. And so that's the big thing I'm focused on when it comes to all of these mega cap names.
Yeah, and man, if this thing turns positive by the close, that's going to be very telling as well. It's only down 0.5% right now. Capital One turning around as well. Anyway, let's move on to CSX, which is also reporting. The transport giant down 4% this week after Union Pacific weak results yesterday, or mixed, I should say. They had rising input costs, labor disputes, weakening macro, a lot of things to watch here. Frank Holland,
Right.
help us unpack this one. And is it going to be a barometer economically, you think?
Well, I don't know if it's going to be a barometer economically, but this one's actually really simple. CSX is a stock that trades on its operating ratio. Operating ratio is the inverse of operating margin. The lower, the better. The street's estimate right now is higher than it was a year ago. The street's estimate is 60.8%. A year ago, that number was 60.1%, and then the year before it was 57%. That means the company's just getting less profitable as we continue on. So obviously the rail deal is one factor. They had to pay their workers more. The other question is, can they still charge the same premium when it comes to freight? And then their biggest segment, that's merchandise. They get more than half of revenue from that. That's autos, metals, and chemicals. Well, there's some headwinds and tailwinds there when it comes to slower consumer spending. Maybe they're not shipping as many autos after earlier in the year. There weren't as many autos to ship. And now with chemicals and things like that, is that a steady stream or is that going to also slow down? So the real question here is, again, operating ratio when it comes to the stock. Is it becoming more profitable or less profitable?
It's a great point, Frank, about how it could be geared to the autos sector. And can't they just report profit margins, Delano, like everybody else, instead of having to make us invert it to figure out what they're saying? What would you do with the stock here?
Yeah, because this is one I actually don't own, but after looking at it, obviously the top line, the bottom line's been growing for them. But the big thing that was kind of cautionary to me was the fact that we are in a macro environment that may see a slowdown and pullback, and that will have some sort of effect on them potentially. They've been doing well with covering costs and being able to, obviously kind of protect themselves over a rising cost period, especially with fuel. But this is one that, is cautionary just because of the macro environment, right? And that's the area that, they would potentially see some headwinds in.
All right, we'll leave it on that rather cautious note as well. Frank, thank you very much, our Frank Holland. You can catch the CEO of CSX on Squawk in the Street tomorrow at 10 a.m. to discuss these results as well. Finally, we have 4 airlines reporting tomorrow, including American and, yes, Southwest. American's up 27% over the past year after they doubled revenue guidance on strong bookings. Southwest expected to report a loss and a big charge from those holiday cancellations. Phil LeBeau is here with the stories. And, Phil, I almost feel as though Southwest is masking the broader story where, was it United in particular that has put up incredible strength in the airline space lately?
Yeah, this is the tale of 2 airlines when you look at American and Southwest. American, we were with the CEO, Robert Isom, a couple of weeks ago when they raised their guidance for the fourth quarter in terms of what to expect. We're going to see strong numbers from them today. That's built in, and that's why you see the strength that you see in shares of American. Southwest, complete opposite. We know there's going to be a big charge related to the holiday meltdown. We know that their guidance is going to reflect the fact that there could be a lingering impact here in terms of costs, in terms of potentially customers booking away. Lots of issues that still need to be sorted out there. So for investors, this is a case where you have specific issues with Southwest. Put them with Southwest. Do not extrapolate those for the rest of the industry.
Right, exactly. And Delano, what about the stocks?
100% right. I think if you look at it over the period of time, all the airline stocks, especially American Airlines, have performed pretty well. Now, of course, Southwest have had a little bit of trouble. And I do agree that that's a specific to Southwest. And if you look at them over a longer period of time, though, that stock has obviously performed really well. So the big thing I'm focusing on when it comes to the airlines is if that business travel returns the same way that leisure travel has returned, right? And so there's still some upside comparing to 2019 numbers to 2022. So overall, liking the industry, I think a lot of American Airlines has been baked into the price. But if investors want to have exposure to this area that still has some upside, it relates to 2019. These are two stocks and two areas that are performing, rather well profitably that you would potentially be in.